Good morning, ladies and gents, and welcome to the final installment for 2025 of the Blackfinch 10-minute market forecast. Thank you for joining us. My name is Jordan Kent, Distribution and Sales Exec for Blackfinch Asset Management, and I'm joined today by Head of Multi-Asset, Mr. Gareth Deacon. Now, for those of you who are joining us for the first time, the goal of this webinar is to provide you with what are, in our opinion, some of the most important events across the globe, helping you to navigate markets and answer your client queries. Now, if you have any questions during today's content, then please be our guest and submit it using the Q&A box at the bottom of your screens. Otherwise, we will be providing you with our contact details towards the end of the session. Now, before we begin an outline of today's topics, it's important that I note that this webinar is intended for financial professionals only, and the content we cover isn't intended to be taken or interpreted as financial advice. So for our topics today, we're starting, of course, with the UK budget. After months of speculation, the announcement we've all been waiting for finally landed last week. But did it actually move markets? With a buy now, pay later fiscal approach, softer growth forecasts, and generally muted sector reactions, the real question is whether this budget meaningfully shifts the outlook for UK assets, or whether it simply clears the cloud of uncertainty investors have been waiting to get past. Next, we'll be turning to the US, where November brought a sharp rise in volatility, particularly with Nvidia's 15% swing capturing headlines. But does this reflect genuine cracks in the AI story, or just heightened sensitivity as expectations climb? With the Fed easing and comparisons to the dot-com era resurfacing, investors are asking whether this is normal turbulence or an early warning sign of things to come. And finally, also from the US, there's been obviously a big development around the future leadership of the Federal Reserve. So with Powell's term ending in 2026 and Trump signaling his preferred successor, it's certainly natural to ask what a Hassett appointment might mean for Fed independence, monetary policy, and subsequently market expectations. So across the UK, US tech, and the Federal Reserve, we're seeing policy shifts, rising volatility, and politics starting to shape the narrative. Question we're therefore left with is how these forces are going to interact as we head into next year. And so with that, I'll now hand over to Gareth to break down what we believe this means for markets. Good morning, Gareth.
Morning, Jordan, and thanks everyone for joining us today. Well, I'm sure you've been bombarded with budget-related updates since last Wednesday. It would really be remiss of me to start anywhere else this morning. I'm not going to go through every element in detail. You'll be glad to hear, and certainly that's a lot more than 10 minutes would take. So let's just focus on the overall headlines here. What was announced was largely as expected. Essentially, what Rachel Reeves has delivered is, can be summarised as a buy now, pay later budget, and we can see that clearly from the chart on the screen here. A combination of OBR forecast revisions, U-turns on previous policy decisions, and new spending commitments has left a gap in public finances which needs to be funded. The size of that gap is up for much debate, but the way in which Rachel Reeves has chosen to tackle that is through a backloaded tightening of fiscal policy via a series of tax rises. As you can see from the chart, though, most of that tightening is penciled in for 2029 and onwards. And with 2029 being an election year, therefore, we have to have a degree of skepticism over whether or not that'll be fully implemented when the time comes. So what essentially they've bought themselves is an opportunity to spend without increasing the taxes just yet. Now, OBR forecasts for growth were reduced, with GDP set to grow by 1.5% in 2025, 0.3% lower than the projections in March due to lower underlying productivity growth. At the same time, the OBR forecast higher levels of inflation, believing it will reach 3.5% rather than 3.2% they previously estimated for 2025, and next year slightly upticking their forecast from 2.1 to 2.5. However, really importantly, there was nothing contained within the budget that was perceived to be particularly inflationary in nature. Now, in terms of market reaction, that last point's really important. Now, muted is probably the best way to describe how markets received the budget. Investors have been waiting for what's felt like an age for this announcement, and with the amount of leaks and speculation, there was nothing contained within the announcement that came as a particular surprise. However, in terms of sector-specific reaction, the lack of inflationary measures will help interest rate-sensitive stocks. Banks rallied as they avoided increased tax levies that had been rumoured in recent weeks. However, house builders and betting stocks were hit the hardest, with the latter in particular not liking increased gambling levies. The budget's done enough to put countries' finances back on a sustainable path, or on a sustainable path. We weren't a million miles away from it before, which may open the door for the Bank of England to cut rates before the end of the year. Markets are certainly pricing that in with a high degree of probability. As such, gilts edged slightly higher, but it was nothing revolutionary. I think the most important thing that can be said about the budget from an investor standpoint now is that it's over. So this cloud that's been hanging over UK assets for what feels like a long time now has at least partially lifted, and we can start to look into 2026 with a bit more clarity about what that means for UK assets. Now, moving on, the other key theme that's dominated the headlines and markets in November was what felt like a sizable uptick in market volatility, particularly in the US. As Jordan's already said, we saw Nvidia's share price drop by nearly 15% in the month. But all that, that sounds like awful on face value, but in reality, all it did was reverse the spike in the share price that had happened in the 10 days to the end of October. So while there's a couple of key reasons for the fall in November, not least the news that the Meta are considering purchasing chips from Alphabet, what it did was highlight an inherent nervousness that seems to be persistent around high growth stocks at the moment. If we look at the chart on the screen, which is from JP Morgan, we can begin to unpick a little bit about why investors aren't feeling quite so buoyant about that AI trend as they were a couple of years ago. What we're looking at here is Nvidia's quarterly revenue and earnings growth beats since the start of 2023. Now, as you can clearly see, while the companies beat earnings and revenue expectations in every quarter, and they did so again in November, the size of those beats has been diminishing as expectations have ramped up. So it's left us in a situation where news doesn't have to be bad to trigger a correction, it just has to be less good than the market's anticipating. Now, we don't believe that the volatility we've seen in November is indicative of the AI bubble bursting by any means. It just points to an environment where volatility is likely to remain elevated. There have been many people comparing the rise in AI to the dot-com boom of the late 90s, and while there's similarities, there are also some crucial differences. And one major difference is that earnings for growth stocks was contracting between 1996 and 2000, even as share prices soared and valuations exploded. And obviously, as we can see on the screen, that's not been the case for Nvidia. It's just that those beats are reducing in scale. Today, earnings per share for growth stocks have been expanding annually at roughly 20%, and that's vital for keeping those forward multiples in check. Without strong earnings, those stocks could be at risk, but at the moment, that's not what we're seeing. Now, secondly, historically, every market top and crash since the 70s has been preceded by Federal Reserve monetary tightening. In other words, rising interest rates have been a key precondition for a market collapse. Now, these sort of rules are fantastic until the first time they're proved not to be true, so we can't take it as a definitive indicator that the market won't fall, but it at least provides a scenario where monetary tightening from the Fed won't be a contributing factor to that. Today, the Fed is preoccupied with a weakening jobs market and has been on an easing track. And just last week, we saw comments from senior Federal Reserve official John Williams suggesting that a softer labour market poses a greater threat to the economy than inflation. And investors have taken that as a signal of an upcoming rate cut in December. This policy backdrop should prolong the market rally rather than killing it. Of course, if inflation roars back and the Fed changes course, all bets are off. However, the Fed changing course, that outcome remains very unlikely. And I'll talk in a minute as to why that's probably even less likely next year. Finally, in the 90s, companies with negative earnings often commanded the highest equity multiples. Today, investors are really aware of the overinvestment and capacity expansion that can't be matched by the profitability the other side of it. And we've seen a couple of times this year where investors have been punishing companies who are increasing this AI capex without a clear route to a return on that spending. So the heightened focus on profitability helps ensure that companies try and strike the right balance. So in conclusion, although parts of the market are frothy and speculative, we don't believe the US market is in a fully fledged AI-driven bubble just yet. But the Mag 7 now make up over a third of the S&P 500. Therefore, this means the kind of inherent volatility of the index is much higher due to that concentration factor. And therefore, investors need to be prepared for sharper and deeper than expected price swings in both directions. So all just speaking to this increase in volatility we expect to continue. So how do we mitigate that volatility for investors? In our view, it's good old-fashioned diversification. Those of you who invest with us already, who've been tuning into these calls for a while now, have known that it's a point we've been trying to make all year, and we're not slowing down with that point. We're no longer in an environment where the only place to make gains in your equity portfolio is the Mag 7. There's many other places, not least emerging markets, which are offering growth potential at more attractive valuations. In fact, back to that point on on volatility, if we look at the monthly volatility characteristics of the S&P 500 against the MSCI Emerging Markets Index, in local currency terms so far this year, the S&P 500 has been 30% more volatile than emerging markets, and that's not a trend that we see ending anytime soon. Finally, I'll just touch really quickly on a piece of news that came out over the weekend in regard to the incoming chair of the Federal Reserve. The term of current chair, Jerome Powell, is due to end in May 2026. And Donald Trump confirmed over the weekend that he's now selected his preferred candidate to take over that position. Whilst he's declined to comment, confirm that the nomination will be Kevin Hassett, current director of Trump's National Economic Council, it's highly anticipated that he will be the president's selection. The announcement's expected soon. Treasury Secretary Scott Bessent, who's overseeing the selection, suggested it could even be before Christmas. So that comes, only days after a report from Bloomberg that Hassett is seen internally in the administration as the front runner. So Trump's confirmation that he's now selected the candidate increases the probability that it will be Hassett. Now, this decision comes after months of public criticism of Fed Chair Jerome Powell, whom Trump has repeatedly berated for not lowering interest rates fast enough, even threatening to fire him at various times over the last 12 months. What you're looking at on the screen here is data from Polymarket. It's essentially a predictions market. Now, while that might sound like I'm essentially showing you betting odds, it's a little bit more than that. Polymarket's part owned by Intercontinental Exchange, a company that owns and operates regulated exchanges like the New York Stock Exchange. So we believe there's a high degree of validity to their data. So I appreciate it's a small chart and it may be a little bit difficult to see, but as you can probably pick out, the white line has taken a massive jump up recently. What we're seeing there, that's the probability of Hassett being selected. We're now looking at north of 70% probability that he will be the selection. In fact, he was on CBS's Face the Nation on Sunday talking about it, calling it a rumor, but also suggesting and acknowledging why market reaction has been positive to him being favourite. Markets reacted favourably to him being named as the favourite. This all reinforces the reason that Trump seems to favour Hassett, which is that he shares close alignment with Trump's aggressive push for further monetary easing. And going back to what I said earlier, that would offer further support to a continued equity bull market. Now, Trump bringing in someone who is quite so closely aligned with his views on where interest rates should go could bring about questions about the independence of the Federal Reserve. But I think it's fair. We all know that something like that isn't going to deter Donald Trump from going ahead with the decision that he feels is best for his view on where monetary policy should be going. With that, I'll hand back over to Jordan.
Thank you very much, Gareth. So in terms of a summary, um, we've got it on screen there, and we'll obviously look to put this recording up on YouTube and via other socials to make sure if you wanted to catch this again, then you are welcome to do so. But otherwise, as promised, if you do have any questions on the topics we've covered, or perhaps you want our views on topics that we haven't covered, you can reach out to Gareth and I using the details on screen now. Equally, if you'd like more details on the AI bubble and the budget, you can find our full write-ups on both of these points on our website by going to blackfinch.com/news. But that does conclude today's session. All that's left me to say from all of us here at Blackfinch is to wish you and your families a very pleasant festive season. And look forward to seeing you in the new year for our next instalment, set at the same time of 8:50 on the 6th of January 2026. Bye for now.